What's going on, traders? Welcome back to the channel. In today's video, we'll be breaking down weekly profiles and how to use them for higher time frame bias confirmation. One of the biggest problems most traders faced after identifying their weekly bias is understanding how the move is actually going to develop throughout the week. Most traders know the direction they want to trade, but they don't know when the expansion is likely to begin, how the market is likely to deliver, or when to start looking for a valid setups. In this video, I'm going to break down what weekly profiles are, what they look like, and how you can use them to align yourself with the market instead of predicting it. Understanding this framework alone can help you avoid unnecessary losses, improve timing, and bring more structure to your trading throughout the week. With that being said, let's get into it. What are weekly profiles? A weekly profile is the structured development of the weekly candle from Monday to Friday, used to understand how price delivers liquidity, forms reversal, or continues expansion throughout the week. It provides higher time frame context by analyzing the behavior and interaction between each trading days within the week. Simply put, it is the process of how a single weekly candle forms its open, its low, its high, and the close throughout the week using the daily candles. For example, if we have a bullish bias for the week, we would anticipate the weekly candle to open, form the low, expand higher to create the high, and then close bullish. Our job as a traders is not to predict every move, but to allow the market to confirm where the weekly low is likely forming. Once that confirmation is in place, we can begin looking for buying opportunities as the week continues to expand higher. The same idea applies in a bearish market, just flipped in reverse. If we are expecting a bearish weekly candle, we anticipate the market to open, form the high first, then expand lower to create the low before closing bearish for the week. Once the weekly high is confirmed, we can begin looking for a short opportunities in alignment with that direction. Now, the question becomes, how do we know whether the market is likely to form an up close or down close week? That's where weekly profiles come in. I personally use 3 profiles to confirm whether the market is actually developing in line with my higher time frame idea. Understanding these profiles gives context to what the market has already done and what it's likely to do next. More importantly, it helps filter whether your bias is aligned with the actual market delivery or if you are completely offside. So let's break down these profiles. A classic expansion week is a market pattern where price establishes a clear direction early in the week and then continue expanding in that direction over multiple days. These profiles follow a very consistent rhythm in the market. In a bullish scenario, the market typically forms the weekly low early in the week, usually on Monday or Tuesday, after reaching into higher time frame discount PD array on the hourly or 4-hour chart. Once the low is established and confirmed, the market begins expanding higher through Wednesday and Thursday as continuation takes place throughout the week. By Friday, price usually begins slowing down after the higher time frame draw on liquidity has been delivered. This is commonly referred to as a TGIF setup, where the market starts capping the weekly range and taking profit into the close of the week. The same idea applies in reverse for a bearish scenario. In a bearish classic expansion week, the market forms the weekly high early in the week, usually Monday or Tuesday, after reaching into a premium PD array on the hourly or 4-hour chart. Once the high is confirmed, the market begins expanding lower through Wednesday and Thursday, delivering bearish continuation throughout the rest of the week. By Friday, the weekly range is typically near completion, and the market may begin slowing down or consolidating after reaching its higher time frame liquidity objective. A midweek reversal profile is a weekly market pattern where price establishes its true direction around Wednesday after moving against that direction earlier in the week. In this profile, the early part of the week creates the setup, while the later part of the week provides the trading opportunity. In a bullish scenario, the market typically forms the weekly low on Wednesday after Monday and Tuesday trade lower against the truly weekly direction. Price usually reaches into a higher time frame discount PD array on the hourly or 4-hour chart before establishing the reversal. Once the low is confirmed, the market begins expanding higher through Thursday and Friday as it delivers into higher time frame draw on liquidity. The same idea applies in reverse for bearish scenario. In a bearish midweek reversal profile, the market forms the weekly high on Wednesday after Monday and Tuesday trade higher against the true weekly direction. Price typically reach into a key premium array or higher time frame level before reversing lower. Once the high is established, we anticipate bearish distribution throughout the remainder of the week as price expands toward the higher time frame liquidity objective. In this profile, Wednesday is where direction is established. However, not every Wednesday reversal is immediately tradable on its own, which is why lower time frame confirmation is still required before execution. A consolidation reversal profile is a weekly market pattern where the early part of the week forms a tight consolidation range before the true move is delivered later in the week. In this profile, Monday through Wednesday build the range with no clear directional expansion. Thursday manipulates the range by breaking above or below liquidity before closing back inside the range. Friday delivers the real expansion in the opposite direction of the Thursday's manipulation. In a bullish scenario, Monday through Wednesday trade sideways, showing that the market is building liquidity within a consolidation range. On Thursday, price breaks below the range, sweeps liquidity and reaches into a higher time frame discount PD array or key level on the hourly chart or above before quickly reversing back inside the range. This creates the setup for Friday where the market expands aggressively higher towards the higher time frame draw on liquidity and completes the weekly range. The same idea applies in reverse for bearish scenario. In a bearish consolidation reversal profile, Monday through Wednesday forms consolidation before Thursday breaks above the range, sweep liquidity and closes back below the highs. This manipulation then sets up Friday for bearish continuation as price expands lower into higher time frame liquidity objective. Now that you understand the 3 weekly profiles we look for in price, it is important to understand that profiles alone are not enough to execute trades. Before looking for an entry, we first need confirmation of a change in state of delivery on the lower time frame such as the hourly chart. This confirmation helps validate that the higher time frame reversal point is in place and allows the following trading days to be approached as continuation opportunities. Since we are trading the continuation after the reversal is established, we allow Monday to do its jobs without forcing position early in the week. Monday is often a lower probability trading day, but the information it provides can help confirm the market's true intention for the rest of the week. By following this process, we avoid predicting and instead align ourselves with the footprints of how the market is actually delivering within the weekly range. So with that being said, let's get into some top-down charts example of each profile. So here we are on the gold daily charts, and what do we notice? Price forms a relevant swing at a key level based on the previous week's price action and then proceeds to close bearish. Below current price, we also have multiple failure swings resting as potential liquidity targets going into the new week. When looking for direction in the market, we always want to trade away from relevant swings and target failure swings in the anticipated direction. In this scenario, that gives us a bearish bias for the coming week. In other words, we are anticipating the weekly candle to form an open high-low close bearish structure. Now, the question becomes, how do we identify and position ourselves within this bearish opportunity? The first step is allowing Monday to do its job and using the information it provides as a context for the rest of the week. Zooming in on this price action, we notice Monday sets the weekly open, but as you can see, it doesn't do much in terms of expansion. One of the reasons Monday is often considered a low probability day is because major high impact news events rarely occurs on Monday. More importantly, when thinking about expansion candles, we should think in terms of accumulation, manipulation, and distribution. If we are expecting a bearish weekly close like this example, Monday may simply create the accumulation phase, We then allow Tuesday, Wednesday, or even Thursday to establish the weekly high through manipulation before the true expansion begins. At this stage, we do not predict which profile we form. We let the market reveal its intention first and then align ourselves with it. Coming into Tuesday, price manipulates higher by trading above Monday's range and reaching into a daily key level, which in this case is a fair value gap. This gives us the classic expansion weekly profile where Tuesday established the high of the week early, allowing us to anticipate bearish continuation throughout the remainder of the week toward the higher time frame draw on liquidity below. Now, moving into Wednesday, before taking any trade, we first need confirmation that Tuesday's high is actually a relevant swing we can trade away from. On the 1 hour time frame, if we track the series of bullish candles that swept Tuesday's high, we can then ask, do we have a bearish change in state of delivery? Yes. Once the bearish CSD confirms, we can begin looking for continuation opportunities. And for continuation entries, we look for a sweep followed by a CSD, a closure through a series of opposing candles, ideally occurring above the opening price during London or New York session. As you can see here, price trades above the opening price, sweeps liquidity, and then deliver a bearish change in state of delivery. This is where execution becomes available. Stops are typically placed above the high of the CSD candle, or in some cases above the candle body, depending on the setup. From there, we can either secure partial at around 2R, target the higher time frame weekly draw on liquidity for larger RR, or use a projected target model. One way to project target is by anchoring the standard deviation Fibonacci from the high to the low of the CSD candle. This provides projected levels such as the -2, -2.5, or even -4 deviations, which often align closely with liquidity objectives and higher time frame target zones. As we can see, price eventually expands lower towards the objective. Again, the goal here is to filter out unnecessary information and position ourselves inside the weekly expansion phase. That is the sweet spot within this framework. And if we zoom back out to the daily chart, you can clearly see the classic expansion weekly profile in action, where Tuesday establishes the high of the week early and the rest of the week continues lower in alignment with the bearish direction. Now, let's move into the second example. Here we are on the pound-dollar daily chart. What do we notice? We can see price drawing into higher time frame premium fair value gap. At the same time, the market is leaving a failure swings below current price, which become potential downside objectives. Remember, when forming a directional bias, we always want to trade away from relevant swings and target failure swings in the anticipated direction. In this case, we already have a failure swing resting below price in the form of equal lows, but we do not yet have a confirmed relevant swing high to trade away from. Mechanically, this allows us to anticipate that the high of the week may form around this premium key level, creating the potential for a open high low close bearish weekly candle structure. Now that we've identified the bearish bias, the next question becomes, how do we participate in the move and which weekly profile is the market likely to form? At this stage, patience becomes important. Our job is to allow the higher time frame key level to be engaged first. We are tracking the potential high of the week so that we can eventually trade away from it towards the downside liquidity objectives below. Until then, there's no reason to force a position. Coming into Monday and Tuesday, price continued trading higher. Then on Wednesday, the market finally reaches into the premium key level and delivers a sharp bearish reversal. This immediately signals the possibility of midweek reversal profiles, where Monday and Tuesday trade against the true weekly direction before Wednesday establish the high of the week and set the stage for continuation lower through Thursday and Friday. Now, before taking any entry, we drop down to the hourly time frame to confirm whether Wednesday's high is actually a relevant swing we can trust and trade away from. To do this, we track the series of bullish candles responsible for creating the high and ask, do we have a bearish change in state of delivery? Yes. Once the bearish CSD confirms, It tells us the reversal is likely in place, allowing us to begin looking for continuation entries to the downside. For continuation entries, we again want to see a sweep of liquidity followed by a bearish CSD above the opening price, preferably during London or New York session. As we can see here, price delivers a quick run above the opening price around the London close before sharply reversing with a bearish change in state of delivery during early New York session. Execution becomes available immediately after the CSD confirms. Stops are placed above the eye of the CSD candle, or in some cases above the candle body depending on the structure. If we are truly bearish, we should not expect price to revisit that eye again, making it our invalidation point. Entries can also be defined further on lower time frames for tighter risk management. From there, we can either secure a static 2-hour target or hold towards the higher time frame weekly draw on liquidity below. As you can see, price expands aggressively toward the downside objective with strong efficiency. That is the exact phase we want to participate in, the expansion phase of the weekly profile. And if we zoom back out to the daily chart, we can clearly see the midweek reversal profile in action. We allowed Wednesday to establish the high of the week, then aligned ourselves with the bearish continuation through Thursday and Friday toward the higher time frame liquidity objective below, which in this case was the daily fair value gap and equal lows resting underneath price. In this final example, we are looking at silver on the daily chart. The first thing we notice is that the market has been in a strong bullish trend and is currently trading near all-time highs. At this stage, we do not yet have any clear relevant swings on either side of the market to frame a directional trade from. Instead, the market is simply leaving failure swings below current price. In a situation like this, there's no reason to force a position. Before looking for opportunities, we first want the market to establish a relevant swing point that we can trade away from. Until then, we wait. Coming into Monday, Tuesday, and Wednesday, price continues trading higher but remains within a relatively tight range. Even though Tuesday and Wednesday close bullish, price never truly expand outside the Monday's range. This begins aligning with the consolidation reversal profile. At this stage, however, we are still waiting for the market to establish a relevant swing high that can confirm the opposite direction. Then on Thursday, price sweeps liquidity above Monday's highs, potentially establishing the high of the week. Now, we can drop to the hourly time frame to confirm whether this is truly a relevant swing high we can trust and trade away from. Once again, we are looking for a bearish change in state of delivery around the high of the week. After the reversal confirms, we can then begin looking for continuation opportunities towards the weekly downside objectives going into Friday. For the entry, we continue following the same execution model. A sweep of liquidity followed by a CSD above or near the opening price, preferably during London or New York session. In this case, if you notice closely, the initial CSD actually forms early in the day during the Asia session. This becomes an important clue that the market may be preparing for a larger expansion move later in the day. Then around the London Open, a continuation entry forms. Again, the process remains exactly the same. Price sweep liquidity into a key level, delivers a bearish change in state of delivery, and execution becomes available after the CSD confirms. Stops are placed above the CSD candle high or above the candle body depending on the structure and desired risk refinement. Targets can be approached in multiple ways: a static 2-hour target, the overall higher time frame liquidity objective, or a projected deviation levels. In this example, we can see how the projected negative 4.5 deviation aligns almost perfectly with the higher time frame liquidity objective below, creating a strong confluence target zone. Price then expand aggressively lower into the objective. And if we zoom back out to the daily charts, we can clearly see how the consolidation reversal profile developed throughout the week. Monday through Wednesday formed a consolidation range. Thursday established the true weekly directional true manipulation, and Friday delivered the expansion phase into the higher time frame objective. With all that being explained, if you take anything away from this video, let it be this: The market does not move randomly. Price delivers in phases, and your job as a trader is not to predict every move, but to align yourself with how the market is actually developing throughout the week. Weekly profiles provide structure. They help you understand where the week is likely forming its high or low, when expansion is most likely to occur, and when conditions simply do not support a trade. Instead of forcing position every day, learn to wait for confirmation, align with the profile, and position yourself inside the expansion phase of the market. That's where the highest probability opportunities exist. Remember, direction first, confirmation second, and execution last. Once you can consistently follow that process, trading becomes a lot more clear, structured, and repeatable. If you found value in this video, make sure to leave a like, subscribe to the channel, and turn on post notifications so you don't miss future breakdowns on market structure, profiles, and execution models. And with that being said, I'll catch you in the next one.